You've seen this chart before. Maybe you've lived this chart before. Price drops into a support zone that you marked out days ago. It taps it almost perfectly. You enter because the zone did exactly what it was supposed to do. And then, within a few candles, it's gone. Price rips straight through and your stop is taken out before the level has even had a chance to prove itself. The instinct that most traders have at that point is to blame the zone. Bad level, bad tool. Maybe support and resistance just does not work anymore. That is not what happened. The zone was not wrong. The way it was used was wrong. In this video, I'm going to break down why support zones fail as often as they do. What is actually happening on the chart when price blows through a level that looks solid, and the framework I use to stop treating a zone like a guarantee, start treating it like what it is. A probability area that needs confirmation. Before we get into why zones fail, we need to agree on what a support zone actually is. Because most of the failures start with a misunderstanding right there. A support zone is not a line. It is not a single price. It is a region where buying pressure has previously been strong enough to absorb selling pressure and turn price around. That is it. It's a historical observation, not a promise about future behavior. The problem is that most traders draw it and treat it as a line, a brick wall, a precise number. And the moment that price touches that exact number, they act as if that level has been confirmed and the trade is safe. Education boundary here, nothing in this video is telling you where price will go next or that any zone will hold. This is about how to read that zone properly, manage risk around it, not predicting outcomes. With that in mind, let's get into the actual reasons zones fail. The first and most common reason a zone fails is that it was never really a zone to begin with. It was one reaction, sometimes even just one wick, and it got treated as if it was structurally significant. A single touch does not tell you that buyers are defending that area. It tells you that buyers showed up once. That could be genuine demand. It could also be a stop hunt, liquidity grab, or noise from a low volume period. A level with one reaction is a hypothesis. A level with multiple reactions, ideally across more than one time frame, is closer to evidence. The strength of a zone is not how good it looks visually. It's how many times price is actually needed to respect it to keep the broader structure intact. Common mistake here. Traders zoom into a 5 or 15 minute chart, they spot a bounce, and then they mark it as a major zone without ever checking whether that level means anything on the 4-hour or the daily chart. A minor intraday reaction and a structurally significant zone can look identical on a small time frame. They are not the same thing. The second reason zones fail is that the zone was evaluated in isolation, with no regard for what price was doing on the way into it. A support zone inside a healthy uptrend and a support zone at the end of a sustained downtrend are not the same setup, even if the price level looks identical on the chart. Momentum matters. Structure matters. What happened in the last several swings also matters. If price is arriving at a zone after a slow, controlled pullback, that's a different story than price arriving at a zone after a sharp, high momentum breakdown. The second scenario often means that sellers are in control, and the zone is more likely to be used as a pause, not as a price floor. This is where AMS, or adaptive market structure, becomes useful. AMS protects you from yourself because it forces you to look at the broader market structure before you act on a single level. A zone is not read in a vacuum. It is read as one piece of a larger structural picture that involves trend, momentum, and prior swing behavior. Here's a common mistake. Traders see that price is at support, they treat that single fact as the whole thesis. Instead, they should be asking, what is the trend doing? Is momentum backing up a reversal? The third reason, and probably the one that costs traders the most money over time, is entering the entire position the moment price taps the zone. Markets don't owe us an entry. A zone tapping does not mean the market is required to bounce cleanly the first time it gets there. Price frequently overshoots. It wicks through, tests liquidity below the zone, and then reclaims it. If your entire position went in at the first touch with a tight stop just underneath, you are almost designed to get stopped out by that overshoot, even in situations where the zone does eventually hold. This is why we ladder in and ladder out. Instead of committing all your capital to one price, you scale your entries across the zone. Give yourself room for that natural noise that happens at any level where there's two sides of the market fighting for control. Laddering does not guarantee a winning trade. It changes how much damage a false move can do to your position. And it reflects something important. You're not predicting an exact bottom, you're participating in a probability zone with position sizing that respects the uncertainty of that zone. The fourth reason that zones fail as trades, even when they do not fail as levels, is that many traders never define in advance what would prove the zone wrong. If you do not know what invalidates your idea, you cannot manage your trade. You're reacting emotionally to every wick instead of following a plan that you built before you had money on the line. Before price ever reaches the zone, you should know the answer to one question. What has to happen for me to accept that this zone did not hold? Not a feeling, not a gut reaction while red numbers are flashing, a specific structural point defined in advance. This single habit removes a huge amount of emotional decision making that turns a manageable loss into an oversized one. So let's come back to the original question. Why do support zones fail? Most of the time, the zone itself was not the failure. The failure was in how it was identified, how the surrounding context was ignored, how the entry was executed as a single point instead of a process, and whether that invalidation was defined before the trade instead of during it. Here is a simple process to run through before you trust any support zone. 1. Confirm the zone with more than one reaction, and check whether it holds meaning across more than one time frame. 2. Read the trend and momentum on the way into that zone, not just the price level itself. 3. Ladder your entries across the zone instead. You don't have to commit everything to the first touch. 4. Define your invalidation point before price gets there, not while you're already in the trade. This is not a system that predicts whether a zone holds. Nothing can do that with certainty. It is a system that puts you in a position to survive being wrong and to actually benefit when the zone does hold, because you approached it with structure instead of assumption. A support zone is not a promise. It is a probability area built from prior price reactions, and it needs to be read alongside trend, momentum, and structure, not in isolation. Most of the trades that should have worked failed because of how they were entered and managed, not because the level itself was meaningless. Watch for single touch zones being treated as major levels. Watch for entries and no invalidation defined in advance. And test laddering into zones instead of committing your full size at the first tap. If you want to go deeper on how AMS ties trend, structure, and entries together in a one repeatable process, that is exactly what the Adaptive Market Structure module inside Spot Trading Mastery course walks through step by step.